Right. First of all, let me share with you a brief introduction about myself. I'm actually from Kuala Lumpur. I started trading the market 32 years ago, started from the Bursa, Malaysia. After I graduate the second year, when I start my first job in AMD, Advanced Micro Devices, I worked for AMD for 5 years, is when I buy my first stock in Malaysia market. After 5 years, I joined Intel in Penang. After that will be Intel MSc in Cyberjaya for another 12 years, working in a factory automation. So those experiences actually gave me something I did not realize is so valuable today, because everything is about semiconductor and AI, right? Yeah, so it helps me to have a significant depth because I've been working in AMD and Intel factory day and night, implementing systems. So what I want to share with you is, what actually makes me want to be a full-time trader is because, in this journey, right, how many of you want to achieve financial independence? Raise your hand. Financial independence. Who is already financially independent? Okay, yeah, I'm sure a lot of you wanted to achieve that. But you see, if you want to do that, you need to take action. Understand? Yeah, so how do you accelerate that journey? I went through a lot of mistakes, and I hope that I have a very steep learning curve on options. So even though I traded for a long time, I didn't attend proper class and didn't do it the right way, right? So after my first .com crash, when I see Intel share crash, yeah, because I got Intel stock option. That's what got me inspired to learn about the US stock market. Okay, so since I joined Intel in 1997, I have Intel stock options. So I learned how to trade the US stock market, and I buy a lot of tech shares because I'm from tech. But I learned my second big lesson. When I trade Malaysian market, my first big lesson, 97 financial crisis. Okay, second big lesson is .com crash. So what I learned from that is don't take risk for granted. So this is where options come into the picture. If I knew options that time, I will know how to protect my risk better. Right? You either have a stop loss, or you use options to hedge. Of course, at a more advanced level, you can use other instruments like futures, right? You have some long and shorts. So what I'm going to share with you today is my favorite instrument, which is options. 80% of my investment and trades are using options. So I've traded options for 20 years and very active. I used to be trading every day. 3 years before I left my full-time job in Intel, because I was so committed to want to make it work so that, in case one day I want to become full-time, or, in Intel there's a lot of retrenchment every 2-3 years, okay? I will be ready, right? You make yourself ready before something happens, right? So I trade almost every day. So in my 3 years before I left my full-time job, guess how many trading days I missed? Not 0, 5 days, okay? Only 5 days. And that 5 days is either I'm sick or I'm traveling. So from that journey, I mean, you don't have to trade like me. But from that journey, what I realized is what can happen on every single day in different market sentiment. And it gave me a lot of experience where you will not get from the textbook. A lot of times option strategy in the textbook seems very simple. Wow, this is a good strategy, or that one looks so good, or if you attend any previews. But until you trade option strategy over the good and bad times, the bull run, the crash, the sideways volatile market, the stable market, you will know the pros and cons of each strategy. And it's a very steep learning curve to learn it on your own. So today I'm going to share with you the hard-earned lessons, and so that it can be simple for you. Who like that idea? I make it hard so that, I learned the hard way, so it can be simple for you. Who likes that idea? Okay, good, thank you. All right, so I'm an educator. We have a company, Beyond Insights, in KL, but we do have international students for 17 years. And over the years, I used to be very technical when I teach, but I learned over the years how to teach in simple way so that people can understand. So you'll be the judge, okay, right, for this. So today's topic is about harnessing options in a shifting global landscape. So how many of you agree that the market is getting more and more complicated, especially when Trump is around? Right? Yeah, Trump get very Trumpy. I remember in 2018, right, he's tweeting so often that, the market can be up 1 or 2 days, then down for 1 or 2 days. Sometimes he will say something really bad about China. After that, he will say that, oh, Xi Jinping is my good friend. Okay, I went through those. So because during that period, many of my students also get worried, right? So people need certainty, right? They don't dare to keep positions overnight. But when you do that, you also miss the big run when it happens because you're not monitoring closely. Right? So options is one method that can help you to overcome this. And I can see that options is becoming more and more important given all this geopolitical tension that we're going to face. Right? How many of you agree that investing is actually very important, right, to overcome inflation and to become financially independent? Who thinks that way? But at the same time, it also makes you very uneasy for the risk. Right? So the key is, it's not about avoiding the risk, it's about how to manage the risk. And learning different instruments can help you to do that. Right? So our goal here is to help you to learn about options so that you can overcome this. Right? But I want to have a disclaimer here. I'm not an investment advisor. Right? In Malaysia, you need to have a license, right, to be able to give stock advice. We are educator. Okay, so whatever I share, the stocks that I'm going to share, my own personal trades, please don't go and buy on Monday. Okay, the market is dynamic. Okay, it's not going to be staying the same. Right. So let me share with you two ways. Right. Who here want to be able to make money faster and yet safe? Raise your hand. Faster but yet safe. Right. So how do you do that? Right. Not everyone has big capital. Probably Singaporean. Right. Your currency is higher, but Malaysian is tougher. Okay. So your $1 here is our 3+ ringgit. So fractional shares become very important for people to invest. So if you are already experienced, I see that there are many experienced investors here, but let me look at the newbie, right? Anyone here are quite new to investing and trading? Like less than 3 years. Can I see a show of hands? Okay, good. You're not alone here, right? So when you're new, depending on your capital size, US stock is perceived to be more expensive. There are stocks even $1,000, one unit. One unit, $1,000. So for people with 5,000 US or 10,000. Like some investors in Malaysia are even lower than that. Then how do you diversify? So the good thing is we have fractional shares, and a few brokers has provided that, and good that moomoo has fractional shares. Means you can buy in 0.0001, okay, fourth decimal place. So this allows you to diversify across many different shares. And this keep it simple because you don't need to learn another instrument first, right? The second way is to use cannot click here. Excuse me? Okay, sorry. How do I go backward? Okay, yeah. So the other way is to use stock with margin. So moomoo provide stock with margin. How many of you are aware about stock with margin? Already using, right? So let's say you want to buy Apple shares in moomoo, right? You just need to pay, the margin requirement is just about 35%. So instead of paying the full price of Apple, you just need to have 35% of Apple share. Okay? But depending on which stock you are buying, the margin requirement is different. So that's another way to make it more affordable. Right? All this is about how to make investing more affordable. Somehow the clicker is not working well. Yeah. All right. So the next one is where options come in. So when you're new, let's say you're totally new to stock market, I would suggest that you build a strong foundation for stock market first. I am a strong advocate on building the foundation gradually, not jumping in straight into options if you haven't understand even the stock market or how stock work. Okay, so build that strong foundation because you need to understand fundamental and technical analysis. So after you have mastered that, then options is one instrument that I highly encourage you to learn because it's the most powerful instrument and it's much safer than futures, right? There is stocks, CFD, options, futures. Right? Futures has unlimited risk as well. Options has limited risk strategy. Okay? Of course, in every instrument, if you master it, you know how to manage the risk better. So let me share with you why options. What are the benefits of options? Right? In options, there are a few benefits here. The first is leverage. This is for people who want to be able to grow the account faster using less money, or if your account size is smaller. So what is the leverage requirement? For example, if you are buying shares, right, you need to pay 100%. Or if you use stock with margin, it could be between 35 to 50%. But if you use options for investing, right, options have, the longer term has 1 year or 2 years expiry. Okay, so it's not infinite, right? So it has expiry. Typically, for 1 year expiry, it's between 8 to 20% of the stock price. Okay, so when you pay 8 to 20% of the stock price, the good thing is you will never lose more than that. Right? Options is an instrument I will share with you later that you will not lose more than what you pay for. So let's say during the dot-com crash, right? During the COVID-19 crisis, or during 2022, where the stock market went down a lot, right? Even the MasterCard went down 60%, right? Even the Amazon, right, also went down a lot. So, but if you only pay 10 to 20%, you will not lose more than that. Okay, so that's one way to look at it. And if you trade short-term, right, so you're not long-term investor, you trade short-term, around 2 months of expiry options is only between 2 to 8%, depending on how volatile. Okay? So there is a big difference compared to pay full with stocks. Right, so that's one of the, when you reduce your cost, then it increases your ROI. Okay? That's how you can make money faster. But you need to do it properly because leverage is a double-edged sword. Okay? The next one, which is one of my favorite as well, especially for investor, you can make money even though the market is sideways. Okay? So this is, I will show you one example later, actually 2 examples on what I do using this income generation. It's a bit like rental income. You buy property, and then you rent it out, right? Which is a favorite for Singapore, right? A lot of Singaporeans. So I think you will love this strategy, okay? Which is a rental income strategy. Then the third one is protection. One of the best part about options is it gives you peace of mind. Okay, for example, when I go for holiday, right? I will make sure that I move all my, even when I have full stock positions, I will change it to options, because I want a peace of mind. So anything can happen after trading for 30 over years, and anything can happen to the market. So, and the best part is options has many ways to protect. Some has protect lesser risk, some has full protection, right? Depends, it's like insurance. And last but not least, this is, if you want to remember, it's LIP, your lip, okay? And last but not least, somehow the signal is not so good. I would need to stand here. Yeah, the last part is about versatility. So what is versatility? Versatility is flexibility. Right? It's a very powerful instrument with a lot of flexibility. It has, later you will learn, there's an expiry and strike price. You can combine in many ways. So to tailor to what you really want to achieve. Okay, I will show you a few scenarios on how do you decide on that. Right? So in essence, this is the three instrument. So this is why I want to use options, right? Which is, it gives me this peace of mind. This is my favorite photo with my husband in Maldives, one of our favorite locations. Anyone have been to Maldives? Yeah, it's like a paradise there. This is, I went there for 5th time already. Okay? A tool that always give you and trade with peace of mind. All right, so let's move on. Can you help me to navigate? Yeah, because it's not so. All right, so let's come down to who has already traded options. Can I see a show of hands? Right, there could be some, wow, a lot. Who has traded for more than 3 years? More than 3 years. More than 3 years, okay? More than 5 years. Okay, so around. So what strategy do you use? I'd like to know. Those of you who have traded, just shout it out. Yeah? Zebra option. That's a unique strategy. It's not a standardized one, right? Okay, later we'll talk. Okay, it's not the, it's just a fancy name someone may have created, but it's a combination that's more important, right? Anyone else? Yes? Single leg option, covered call. Anything else? Yes? CSP. Okay, I think it's all these are probably some trainers created some unique name for them. Okay, yeah, to make it more fancy. Yep. Yeah, straddle, strangle. Okay. Yeah, so there are many of these combinations, but let's come to basic, right? The basic level option, because there's still a lot of you haven't learned options. For those of you who have learned, like just bear with us for some time first. There are 2 main options type. One is called a call option. The other one is called a put option. Right, it's very easy to remember. When you call someone, in the old days, you know, those kind of old phone, okay, to pick it up, right? Yeah, so you call someone, that means it's to trade up, right? Put option is to, when you put down the phone, is to trade down, right? That's an easy way to remember. But what is the different usage of these 2, right? Let me share a bit of the technical definition first, then I'll make it more layman, right? So options is actually a contract between 2 persons, okay? A buyer and a seller. And this contract gives the buyer of the call, let's say I buy a call option on Apple, right? Then it gives me, as a buyer, the right to buy the underlying asset. So this case is Apple, right? Give me the right to buy Apple at a certain price on or before an expiry. Okay, that's the right that I have. So let me give you a simple analogy, since Singaporeans like to invest in properties, right? So when you want to buy a property, right, you can pay a booking fee, isn't it? Right, to lock in the price. So what is the percentage of the booking fee here when you want to buy a property? Anyone here buy property pay full? That's like you invest in shares, you pay full, right? Yeah, how many percent is the down payment? 5%. Okay, so in Malaysia, depending on whether it's an offer period, it could be like 10%. So when you pay, let's say 5% or 10% booking fee, right, that means you lock the price, right? So it's a bit like call option, right? That means once you pay your booking fee, you get to right to buy the property at an agreed price. After you pay the booking fee, can the seller change their mind even though the market price go up? They cannot. Can you understand? Similar concept, right? Yeah. But do you have forever to lock in the price? No, you must have a time period where you need to pay the difference. You need to get the bank loan, right? Yeah, so that is called the expiry date of the contract. Your rights expire on this date. So you need to either exercise it or in the option stock market, you can sell your rights to someone. So it's like a stock exchange. You can buy and sell shares. There's an options exchange. You can buy and sell options contract, right? So it's not like property, right? Property, can you sell your booking to someone? You can if the developer allow it, right? But it's not so liquid. You don't have an exchange to manage your property booking. You understand so far? Yeah. So it's easier to relate to something that you know to something that you don't know, right? So the good thing about options is there are many, many choices. So a call option, you can use it for many, many different purposes, right? Example, like before I go to put options, which is more sophisticated, why would someone want to buy a call option instead of buying the stock? Anyone can think of that? Leverage. Yes, very good. Leverage, because it costs you less money. Example, right? Let's say the booking fee, right? If you pay 5% to give you the right to buy Apple share later, you have leverage. Because when Apple share go up, do you think this contract will be worth more? Yes. So then you can sell it at a higher price. You don't even need to exercise it. Because when you exercise your right, you have to take up the Apple share, which costs you a lot of money. Okay? So you buy, let's say you pay 5%, and it goes up, this contract went up to 10%, you just sell it to someone else, and you will gain 100%. A lot of people may not realize, those seasoned property investors, you should know, right? If you do flipping, flipping, you pay 10%, the property go up, you can sell it to someone else. Actually, you don't even need to take out the property. You pay 10%, and the property went up another 10%, you could actually technically have 100% gain, right? Exclude all the fees, right? So that's the concept over here. Okay, so now that's call option. The second one is put option. One is to trade up, the other one is to trade down. And put option has two basic purposes. One is to trade down, right? Look at the definition. How many of you can detect there's only one word difference between the left and the right? Yeah, buy and sell. So call option gives you the right to buy. Put option gives you the right to sell. So when you give you the right to sell, means, let's say, I would like to talk about in the insurance manner first, it's easier to understand. So let's say you buy a car, right? In Singapore, car is very expensive, okay? So in Malaysia, cheaper. Let's say you buy a car, 100,000, okay, 100,000. So now you're worried the car disappear, okay, theft or whatever. So what can you do? You can buy a insurance, right? Yeah, full insurance. That means if the car is stolen, you get to claim back 100% of the car price from the insurance company. Right? This is like a put option. How much do you need to pay for 100,000 ringgit? Let's say I come from Malaysia. 100,000 ringgit car is roughly close to, let's say, 3,000 ringgit, about 3% of the car price. By paying that, you have peace of mind. Yeah? Rather than you don't pay insurance, your car stolen, you lost 100,000. But can you choose to protect less in a car? Can you choose to protect less? You can. You can choose to protect, 90,000, because you think the probability of car stolen is very little. Okay? Probability of accident is higher. So you say, I don't have to protect so much. So you say, I want to protect a 90,000 in case the car disappears. So I can buy a lower insurance. Okay? So options is, the implementation is something like this. You can, instead of protecting a car, now you're protecting a stock. Let's say you buy a stock at $100. Then you buy a put option at $100. Right? Look at the definition. Let's say in what situation you will use this? Example, there's an earnings announcement, and you're worried that the earnings is bad and it kept down. Bypass your stop loss even if you have one. Okay? Oh, you know Trump is about to speak about China tariff. Okay? Yeah. Remember the Liberation Day, April 2nd? So for you to have peace of mind, you bought the stock at $100. You buy an insurance to protect the stock. So that's called a put option. You buy one put option contract to protect 100 units of stock. Okay, later I will cover. There's a contract size. So by buying one put option contract to protect at $100, you get the right to do what? Sell the underlying asset, sell the stock at the protect price. You can choose to protect at 100, 95, or 90. If you protect lower, it's cheaper. Okay, you want to protect full, you pay higher premium. It's like insurance premium. So you can also say, how long do you want to protect? So you know that the earnings is only, let's say next week is earnings, you just need to protect until after earnings. After earnings, you don't need the protection. Okay, then you can buy a 2 weeks insurance. Okay, you have a lot of choice, right? And there's other considerations, but this is what you can consider. If you want to protect against some major economic announcement like FOMC, then you will consider what's the duration, right? So that's why the expiry is there. The certain price is what level you want to protect. Okay, so that's why options is flexible, right? There's a lot of flexibility to based on your objective. What is your objective? Can you understand so far? Yeah, this is like protecting a car, change to protecting a stock. However, you may not need to do that because this is more costly. You have to buy the stock, right? You have to buy the stock first, 100 units of stock, then you buy a put insurance. It's expensive strategy. But instead of that, let's say you know that the stock, there's a high probability of going down, or the overall market is going to be bearish, or already started to be bearish, you can just buy a put option to trade down. In this case, no stock is involved. Okay? You just buy a put option, let's say on QQQ, if you think QQQ is bearish, right? Buy a put option on QQQ, and you can choose the strike price and the expiry, right? Assuming you buy a 2 months expiry QQQ, and QQQ dropped $20. You still have the right to sell QQQ back at your original price here. Yeah, that's how you make money. Understand? Yeah, so put option has two purposes. So this is at the foundation level of options. However, options is so powerful that you can combine options in many ways. For example, you can combine one call option with another call option that has different expiry, different exercise price. You can combine 2 put options or even 4 put options. You can combine a call and a put. You can buy 3 calls and sell 2 calls. So it is so flexible. Okay? However, you don't go there until you become, you have a strong foundation. Right? Then you will see that options is very powerful to meet the, you can look at the market, based on this market, how can I capitalize? Okay, what do I want to do? Do I want to protect or do I want to speculate? Then you can choose the right expiry and strike price, depending on how bullish is the market. Is it good? Can comprehend so far, or am I losing anyone? Okay, all right. So next, so this is this concept just now, right? Relate to what you know, right? Buying a call is like paying a booking fee for a house. Buying a put is like buying an insurance for your car. Okay. All right, so the most important is how do you make money, okay? So when you buy a call on the left, right, you can be a buyer or a seller of a call option. Or you can be a buyer or a seller of a put option. So when you trade stock market, this is one of the transition you need. In the stock market, you either buy the share and you sell back your share, okay? But in options, it's a bit different. Yeah, you can be a buyer of call and seller of call. You can start with selling first or start with buying first. Okay, so I want to keep it simple. When you start to learn option, you should start with buyer. Okay, buyer, because it's limited risk. Seller is unlimited risk. Right, start with buyer because it's easier to understand. So when you are a buyer of a call, you make money when the stock goes up. Okay, example here. Let me go backward. Okay, go backward. Yeah, over here. You make money when the stock goes up. The more the stock goes up, the more your call option premium goes up, because the definition of call option is you get the right to buy the share at the exercise price that you agree. Yeah, it's called the strike price. So when the stock goes up, you still get the right to buy lower. That's why your option contract become more and more valuable as the stock goes up. But what is your risk? Your risk is whatever you pay. You will not risk. Let's say you pay 5% of the stock price as a premium. That's your maximum total loss. Do you have a peace of mind this way? Yeah. But if nothing happened, you will lose money. Okay, so what about put option? Put option is the other way around. The more it goes down, the more it crashes, the more you make money. But the amount you pay is still fixed. So what if instead of go down, it goes up? You only lose the maximum, which is whatever the premium that you pay. Okay? So now, let's look at the other way around. What if you are not a buyer of the call, but you are a seller of the call? Right? Then you make money on the opposite direction. Sideways to down, you lose money. Okay? Sideways to down, you lose money. And for the seller of the put, it's just opposite. Right? If you buy a put, the stock come down, you make money. If you sell the put, it's the other way around. So in options, you can trade this 4 directions. You can be buyer of a call, buyer of a put, seller of a call, seller of a put. But how do you choose? It really depends on the chart and your objectives. I would encourage people to start with being a buyer because I actually don't like the seller strategy personally. I know a lot of people are teaching this in the market. There's a lot of inherent risk in seller. Okay? There's something called naked seller, which is very high risk. You may not realize it. These are some of the strategies I've used for 30 plus years, so I know the pros and cons and how deep. If you haven't gone through a crisis, you will not know how bad this strategy is. Okay? Yeah, from a reward always is very bad. Let me give you an example here. Right? When you buy, you pay, let's say, a premium or 5% of stock price. Okay, as a buyer, the most you lose is 5% of stock price. But when you're a seller, the most you receive from the buyer is 5%. But if it goes against you, you have unlimited risk. Okay? This one, you pay 5%. The more the stock goes up, the more you make money. From a reward over the risk is very good. Okay? Your risk is fixed. The more it goes up, the more you make money. But as a seller, your income is fixed. Your risk is unlimited. Of course, some said you can have a stop loss. Okay? You can have a stop loss. But stop loss can be bypassed as well. Yeah. So if you do this enough, this is a low reward, high risk. So some people, they will sell this strategy as high success rate, 80%, 90% success rate. But it is still, to me, I have evaluated this in depth, traded it for a long time. It is still not worth it to do. Okay? Because high success rate is an illusion. You can have high success rate. When you win a little. When you lose a lot. And trade it for so many years. There's this thing called Murphy Law. Right? If you have 4 consecutive volatile periods in 1 month, it will kill your account. Yeah. Because when you lose a lot. And there's a lot of psychology issues related to sell put. Because when it goes down, when you collect $5, when it goes down, you may need $10 to buy back. Do you think people will do that? They won't. Anyone here has used naked selling before? Sell put or cash secured put. Right? Have you traded long enough for that? Yeah. Have you experienced what I mentioned? Yeah, sorry? Sorry? Yeah, have you experienced that the more it goes down, it's very hard to buy back? Right? Yeah, you can end up margin call. Okay? Yeah, so my advice for you, because here is supposed to be an introduction first, but I just want to highlight to you, this is not advisable strategy, right? Yeah, so of course, different guru may have different perspectives. This is just, so if you want to do this, understand it in depth first, the pros and cons before you use it, okay? All right, so now, the best part is you can combine this and it will become a different chart. Okay, you can combine 2 call, it will become a bull call spread. You buy a call, sometimes the call option is expensive. It may not be $5, it could be $20. Expensive. So if it goes sideways, your $20 will become 0 over time. It doesn't move. So what do? You can buy a call option, you sell another higher strike price to make it cheaper. So that is where the power options come in. It's flexible so that you can combine to achieve the objective that you want. All right? So can you help me to move on? Okay, so now, in essence, how does options work behind the scene, right? Although you don't need to understand behind the scene. You have someone who thinks that the share will go up, but then you buy a call. But there are people who think opposite, right? The world is big enough that nobody thinks the same. Right? If everybody thinks the same, there's no market. Because everyone want to buy, nobody want to sell, right? Cannot transact. So there will be people on the opposite side who think that this stock is either going to be sideways to down. Okay, so then you get a deal, and the center is a broker. Broker actually connect you with a buyer and seller, and the broker go through the options exchange. Okay? All right, can you help me to next? Okay, so just one simple concept here. Depend on which country you're trading. For the US, when you buy one call option contract, it gives you the right to 100 units of share. Okay, so don't get it wrong. That means some strategy is called covered call. You buy 100 units of stock, then you sell one call. So don't sell 100 calls. Okay, yeah. So it's still much more affordable compared to when I first started. Okay, I also have traded UK options and Australia options before. In the past, one options contract give you the right to 1,000 units. Okay, so the options become very expensive. So 100 is very affordable. Okay, so this is one options contract is equivalent to 100 units of stocks. All right, so now let's get to the moomoo platform. Okay, it's a bit small. Let me do my best to. Are you able to see the font? Otherwise, need to zoom in because the laptop is not here, so I cannot zoom in for you. On the top left is the stock. Right? This is when you can choose a stock first. After that, you go to the menu called options. Okay, then you will be able to see this. So it will show you the current price. After that, you can see here there's a 2-column. Yeah, on the left, there's a many expiry. Remember that you have to choose expiry and strike price. Yeah? Just now I said exercise price to make it more layman. Yeah? The technical term in the platform is called strike price. Yeah? The same as what rights do you want, at what price, or what price you want to protect. Okay? Then the left-hand side, yeah, somehow not sure why, I need to stand closer. Okay? Yeah, so there are a few expiry. In options, there are multiple expiry. Okay, now it become more and more. Okay, in the past, the standard expiry is third Friday of the month. That's called the monthly expiry. But every quarter, you also have quarterly expiry. Okay, that's usually for the big funds for hedging. And now you already have weekly expiry. That means every Friday there's an expiry. And you even have daily expiry for index. Right, so there are many ways to trade. Right, so there are a new popular one is called 0 days to expiration. That means you trade 2 days expiry. But that one requires much more experience and require intraday skills. Okay, I do trade that, but I don't advocate beginners to do that. Right? So these are many choices. So the first thing you need to do before you come to the option chain is you need to look at the stock chart. You need to decide what stock do you want to buy or what stock do you want to trade. Okay, then you look at the stock chart. Where would you have entered based on stock first? Right, based on whatever strategy, some of you are long-term, short-term, or intraday, or swing trading. How would you have traded the stock? Okay, based on that, let's say near the support you would have buy at what level. Then only you come to option chain. Right, then only you select what expiry and strike price. Right, depending on how long you're keeping the position. Okay, so that's why there are multiple expiry here. So over here, there's the December, November, December, January. Okay, I just show you the monthly expiry because otherwise there'll be too many weekly. Then on the left-hand column, there's call option. The right hand is, can you help me to click? Yeah. Somehow, everything, okay. Now we come very fast. Okay, can you see here? Left-hand column is call option. The right-hand side is put option. And on the center, you can see something called strike price. Yeah, strike price is what is the right for you to buy the share. Example, when you're new to option, there's usually one common confusion. The difference between stock price and strike price. The stock price, over here, let me read the stock price. The stock price right now is $262.24. Okay, that's the stock price for Apple. But you can buy a call option to give you the right to buy at multiple level of price. Yeah, so that's where the center. You can choose to buy Apple at 260, right? Example here. Yeah, I'm talking about this, 260, when the stock is at 262, right? Or you can choose this expiry November, right? If you buy November, this is the quote. You don't have to do computation, right? This is, if you buy a November expiry, $260 strike price call option, the system will quote you 1060. So that's where the leverage come in, right? If you buy Apple share, 100 unit, it will cost you 100 times the current market price. 100 times 262. Is that expensive? 26,000. Okay, 26,000. But if you use option, it will only cost you $10.60, you still need to multiply 100, so it's only 1,000 plus. Okay, 1,000 plus. But if you want to give it more time to go up, then you can choose January expiry. Okay, January expiry. So this is like a midterm trade. It will cost you more, $15.70. It gives more time for Apple stock to go up. And the best part of it is, when you pay $15.70 here, the most you would ever lose from now until expiry is $15.70. But if you buy the Apple share straight off, how much can you lose? Can it be more than $15.70? Possible. So can you have peace of mind when you pay only $15.70? If you take $15.70, divide by Apple stock price, 262, how many percent is that? Quite low, right? Yeah. However, what is the drawback? If Apple don't move, week by week, after 1 month, still sideways, what do you think will happen to the 1570? Yeah, it will roughly become, after trading so long, I know how to estimate. It will roughly become after left 1 month, it will be roughly become 1060. Yeah, because this one is about 1 month, okay? Right, so you lose $5. That's called time value decay. No momentum. So when you buy a call option, a lot of people make this mistake. They keep until the expiry, hoping that some miracle will happen. You don't do that. We always close it ahead of time. Right? You don't waste the last part. Right? Don't be in denial. It's very easy to be in denial when you trade options. Okay? Yeah. So can you understand so far? So why is it called options? There's a lot of options. So what are the options? You can buy a call or a put. You can be seller of a call or seller of a put, and you can choose so many, right? You can choose what strike price. You can choose what expiry. So it can become very complex when you're new. And we understand that. So what we do is, we have a process map for our student. If you're trading swing, then this is what you do. When you're trading swing, it's 2 weeks. 2 weeks, you will hit your target, right? Yeah, then you will choose this expiry. No need to have so much choice. And this will be the strike price. 2 strike price. And we explain why. So you overcome all the complexity. And you're trading midterm trend, then this is what you do. Okay? Until you get experience, then you can have your variety. Okay? And you will automatically know what to do with all the choices. Don't give yourself too much choices. Like set lunch versus a la carte. Okay? Right? Set lunch. Who likes set lunch? Who like a la carte? The rest, not sure. When you go for a la carte, what's the problem? You take a little time or a long time to decide. A long time. By the time you decide, the stock has moved. Okay? Yeah. So you need to be clear how to trade options. All right? So this is next. All right. So now I bring it to more layman. How do you implement? And hopefully through this, a lot of you will, especially most of you have traded stocks before, right? You should be able to relate. So I'm using a swing trading example, a simplified version. So let's say there's a support at 100 and there's a resistance at 110. Okay? And you want to trade from support to resistance only, short-term swing trading. And usually this is a 1 to 2 weeks trade. Yeah. So let's move on. Let's say we always buy above support, not at the support, because a lot of people queue at round number. Assuming that you buy at $100.50. I don't even put $100.50. I will put 105, 156. Okay? I want to beat the queue a bit. Yeah. So I want to keep it simple. Let's say you buy at $100.50 and you want to sell default profit target $109.50. This is how, let's say, you will have traded a swing trading, like short-term trade. Okay, so how much will it cost you? If you buy 100 units, then it will cost 100 units times $100.50. It will cost you, this trade itself is $10,050 US dollar. So how much money would you make? The stock went up $9, so you will make 900. So what is your return? 9%. 9% in roughly, let's say, swing trade normally about 1 to 2 weeks. 9% in 2 weeks, is it good money? It's good money, right? Yeah. But let's say if you use options instead, then what will happen? Yeah, I realize I need to stand here, otherwise it doesn't work. I think it's too far. So one options contract for this will be only around $5. So if you ask me why $5, it's an estimate based on my experience looking at the expiry. This is about 2 months expiry. Okay, for different volatility is different. Okay, so for a 2 months expiry, buying at 100, it will be roughly around $5. Okay, it's plus minus, depend on the stock volatility. And when the stock goes up $9, options premium will not go up $9. Okay, there's a concept called delta. It will be $9 times a specific ratio. Okay, you don't have to understand that for now because you already pay a premium. Okay, so the option premium will go up to $10. Okay, or more than that. So I would know that exactly. I would know definitely it will be worth at least how much. Okay, how do I derive that? When the stock becomes $100.09, like 109.5, because I buy a call option, this call option gives me the right to buy at $100. Let's say I buy a $100 strike price option. Okay, that means I have the right to buy the share at 100, right? Now the share is 109.5. Do I have an advantage? How much advantage do I have compared to the market price? $9.50. So this premium will be at least $9.50. But because there's still time, it's not expired yet, people still have speculation price. It's called time value. It will be $9.50 plus some extra. Okay, so that's why I put $10 is actually conservative. I just want to make it easy calculation. So I bought at $5. When it goes up, I can sell at 10. So I will make a profit of $5, 500. Okay, so even though I make lesser, right? Here I make 900, here I make 500. But it only cost me 500 to make this 500. Right, this one I need to pay 10,000 to make this. So my return here is 100%. Is it good? Who likes to use less money to make more money? Yeah. And guess what's the best part? It's when you're wrong, okay? The worst case loss is $5, assuming it gapped down. Okay, for whatever reason, it gapped down. Right? Let's say you trade over, you use this over earnings. The most you risk is $5. But this one, it could go down $10, right? Yeah, it became 90, and you can lose $10. Okay? But you need to use it in the right context. Right? The learning option is not enough. You need to know when to trade up, when to trade down, when to trade sideways. Okay? Easy to understand? Can understand so far? Can I see a show of hands? Who is lost already? It's okay. Okay? Can talk to our team outside. Yeah, we have our team who is very good at options. Yeah. Okay, so now I'm going to show you some exact trade, some trades that I make. And it's on a stock that definitely you will know. Guess what stock is that? Futu, not NVIDIA. Futu. I have a lot of past trades I share on NVIDIA to my team, but now, okay, I choose. This is moomoo Forum must show Futu shares. So this is a trade I make earlier. This is 2024, but it's a simple call option trade. I don't do a lot of simple call option. I do a lot of combination. So that's why but this is good for beginners to understand. So look at the chart, right? The first thing is always the chart. And let me show you, this is where my actual trades. This is where I enter. And this is where I exit, okay? Yeah, it's a simple swing trade from a breakout, support to resistance. Simple trade, and just take 2 weeks to hit the target. So when I buy this call option, if I were to buy the share, it will cost me $52. Okay, it will cost me 52 times 100 units of share, if I want to buy 100, okay? I want to do apple-to-apple comparison, because options have to compare with 100 units. And when I sell, it's 64, right? So I still make $12 if I buy stock, 23%. Okay, but I choose to buy options, right? So because I buy option, it only costs me $7.41 instead of 52. Like this is a bit on the high end because Futu shares has more upside, so the premium is higher, right? The options premium is determined by the volatility of the perception of the how much upside or downside, right? So if there's a perception of further upside, then it's more costly, right? Or let's say you buy a put, people think very bearish, then it's more costly, okay? Yeah. So then when the stock hit the, sorry, let me go back, yeah. So when the stock hit the profit target, I sold it at $16.14. So can you see here? I make I pay $7.41 and I make $8.71, so it's 118%. Is that good? Yeah, this is a simple trade. You can even make it cheaper, right? This one, it depends on whether you think it's pretty bullish. I see the momentum there, that's why I buy a call. But it's at the stretch level. It went up too fast. At the stretch level, I decided to close it. In fact, the expiry date I choose is a few months, right? This stock is, I entered this around end of February, but I choose a June expiry. So I give it more time. The time value doesn't decay so fast. But it hit the target, I just close it. You see, you don't have to wait until the expiry. You must know your objective. Your objective is trade from here to here, then get out. Simple? Yeah. So from this, you can contrast, and this is good money with a small amount, right? I made just 2 weeks, right? This is about 8,000 plus US dollar, right? A good swing trade. All right, so let's move on. This is another of my favorite strategy, and this is the very recent trade, okay? So to show you Google covered calls. What is covered call? Covered call is like buying a house or a condo here, and you rent it out, right? In this case, buy stock. And this strategy is a moderate bullish strategy, okay? You don't do this when the stock is bullish. Bullish, you buy a call, okay? Moderate bullish, that means it could be sideways. Then if you go up, also not so bullish, right? So like this, it went sideways for a while, okay? And I've been waiting for, this is the EMA. So I've been waiting for it to stabilize because this is stretched from the EMA level. So when it's near here, right, I start to collect the stocks, right? This is already a fundamental stock I want to buy anyway, right? So what I do is, can you see here? For covered call, you have to buy minimum units of 100. You buy 100, like you buy the property, then you rent it out. So rent out in this concept is you sell a call option. Instead of buying a call option, you sell a call option. Okay? So example, let me show you an Excel trade. So this is where the support is, the sideways temporary support, 275, right? And I stagger buy in these two. Let me pop up these two. So I stagger buy on these 2 days. Right, you cannot get a ideal perfect timing if you want lifestyle, right? Just put a pending order, okay, let it hit. So the average price is 277 and this 500 units. But this is more costly because you have to take 500 times this share price. Huh? Is it costly? Yeah, so covered call is a more costly strategy because you have to buy the condo first, okay? Yeah, it's not like buying a call, it's cheaper. So depending on your account size, you will choose different strategy. But the good thing is, after I bought the stock, I sell a call option, right? This call option, the strike price is 330. Right, 330 is here. Okay, this is when the stock is here, I sell a 330. And I get back $14. So straight away, I pocket $14, which is, there has two meaning. Straight away, I get a discount on the stock. Okay, so this is the advantage of options. Let me check. Yeah, this is one huge advantage of people who know options and don't know options, especially for investor. If you don't know options, you'll be buying based on the market price. Okay? But if you know options, you can get an immediate discount by buying the stock and straight away sell a call option. But how do you decide? Okay, this is where your experience comes in looking at the fundamental and technical. How high do you think the stock will go up? Right? Let's say you can choose to sell a monthly option. Then you look at how much the stock can go up within the next 1 month. You can sell a monthly or you can sell 2-3 months ahead. Okay, depend on whether you want protection or you want more premium. Okay, what it does here is there's a pro and cons. If the stock stay below 330, never go above, the buyer will their premium expire worthless. Okay, expire worthless means there's no advantage for their call because they buy a call option that gives them the right to buy at 330. The stock on expiry is still below 330. Will anyone exercise the right? No. So it will expire worthless. Who make money? The person who sell, which is me, okay? So there's two advantages. One is, let's say the stock didn't go up, it goes sideways, sideways, sideways. Oh, expire. Right? The stock could be when I buy is here, on expiry is still here. If you just buy stock, do you make money? No. But because I buy a stock and I sell option, I still make $14.73. Yeah, so I have extra income. So typically, how much income can you get? It will be between 2 to 4% usually, right? The more volatile the stock, the more you can collect. Sometimes you can get 5% for some volatile stocks. So let's say conservatively, you look at 2%. Okay, that's already low volatile stock. Times 12 is already 24% per year. Even though the stock stays sideways, you still get 24% per year. Is that good income? Yeah, right? But if you want to sell a higher, you don't want to be capped. The disadvantage is if the stock goes above 330, your stock will be called call away. Because the buyer of the call will exercise the right to buy the stock from you at 330. But is it okay? It's okay because you bought the stock lower. Just give it to him because you can always buy it back. Next month, you start all over again. Understand? Yeah. So what we cover in our class is to teach you how to do the selection and the pro and cons for that, right? Like in what circumstances you choose what expiry, right? Let's say depend on you want more protection or you want more premium. You sell month by month more premium, but less protection. Then the strike price is the tricky one. because you need more knowledge understanding the potential upside of the stock. Okay, you don't want to end up, you sell, wow, the stock's super bullish, then you regret. Okay, because when you do that, this strategy is such that the one that you buy, you will make money when it goes up. The one that you sell, you will lose money, like in this case. Okay, so you have to think of this as a package. Okay, you have to see this is a combination. The combination will make money on the way up. Like some students, when they are new, they say, how come I lose money on the second part? They cannot take it, must be win every single trade. Yeah, this is not the way this strategy works. Okay, so let me share with you quickly on the advantage here. This strategy, let me bump in. Can I have the, is it low battery? Okay, yeah, the pro is you get an immediate discount of your stock. Okay, straight away you collect premium. It's like you are able to buy lower than other people in the market, and you can make money even though it's sideways. Okay, but what is the cons? The cons is your profit is capped based on the sell leg strike price, and it's more expensive because you need to at least buy the 100 units of share. So it's not for the smaller account size holder, especially depending on the stock price. This is Google, so it's more expensive. One share is $277, right? But you can choose stock that are below $50. Okay, below $50, so it's cheaper, relatively cheaper. All right, so let's move on. All right, so I just show you two strategies because I only have 1 hour here. But options is very versatile. You can use options to trade up. Example here, if you think the market is bullish, you can buy a call option. If you think the market is bearish, you can buy a put option. That's called directional trade. If you think it's moderate bullish, you can buy a call, sell a call. It's called bull call spread. Okay, yeah. Example, right? First, you need to identify. This is phases of the trend, right? This is phase 1. Right? Phase 1 consolidation will have suitable strategy. Phase 2 uptrend, right? You use bullish strategy. Okay. Then after that, we are here, right? S&P 500 is here right now. Consolidation is more shaky. More shaky. If you see a strong stock, cover call is good. Because it can go, because people are worried, a lot of news about overvalue, but then the support still hold. Overvalue, but support still hold, come to support, right? So you can do a cover, you buy the stock, you sell the monthly options, or you can sell 2-3 months. Then even though it's sideways, after 3 months, you still collect rental. Is that good? Yeah, and you have a less anxiety because straight away you can have a discount on the stock. Okay, so this is at the stage 3, right? Yeah, so, but what if it's downtrend? Downtrend is stage 4 trends already. When it's downtrend, you can buy a put. When the put is expensive, you do a bear put. You buy a put, sell a put to make it cheaper. Okay? Or when it's moderate bearish. Then, so this is called multi-directional. There's also strategy when it's range bound. This is range bound, right? There's a range bound strategy. I don't like to do this because I trade a lot of strong fundamental stocks, right? So it won't stay sideways for too long, but there's something called a iron condor, okay? Which is a combination of 2 credit spread, okay? Then so there are 2 popular strategies for this and 2 popular strategies for trading down. And this one is, this one also, you can also trade. There's a strategy where as long as they stay above support, you make money. Or as long as stay below resistance, you make money. Okay, so that's another strategy. And just now I also mentioned the rental income. So I show you Google cover call. So this is my Futu cover call. Okay, Futu shares here. You can see I buy Futu share. What happened? Okay, 800 units at 163. And the last when I capture is 179. Right. So I make 12,000 from the stock itself. But I sold a call. Right, when I bought at 163, I sell 180 call, and I collect $13. I collect $13 straight away. That means I don't need the stock to go so high. I don't need the stock to reach 180 for you to make the money. Even though the stock stay at the end of the month, still 163, I still collect $13. Is it good? Yeah, and if it go up, it's good. If it go up, I make from the stock 163 to 180. That's how much I can make from the stock go up. At the same time, I have additional income from my rental income. Okay, so this is one of my favorite strategies for investing, but you need to look at the right market sentiment to do that. Okay, not when it's like about to have a bearish sentiment. Okay, so now, so I explained the benefit, but what do you need to look out for? Right? This is a summary of what to be aware of when you trade options. The first one is you need to choose when to be a buyer, when to be a protected seller, okay, not naked seller. Yeah, those who have traded, you understand what I mean here. So if you are a buyer, there's this thing called time value decay. So you need to make sure that it doesn't lose momentum, right? So let's say when you buy, you expect it to move. So I have this sharing with my team usually. In trading, you need to look at what do you expect to happen. If what you expect to happen, you expect it to be bullish, you expect it to move after you buy, and that doesn't happen, it's a warning. Especially when other stocks are bullish, this stock is weak. Then that's when you need to kill it. Okay? Yeah, those are where I actually shared the experience with my team, with our students. So how to overcome this? You ensure that you use the right strategy for the right market condition. The next one is, it's more sophisticated. As you can see, there are many, many choices. The sophistication is, I won't say it's a rocket science, right? It's just that you're not comfortable with it for a start. Like it's a different animal compared to stock. There's expiry, there's strike price, there's so many choices. But if you give yourself time to master one thing at a time, start with the call. Then when the call is expensive, do a bull call, okay? Buy a call, sell a call. Start with that. Gradually, only you go more sophisticated. Then options can be simple. Okay, but overall, you need to practice to internalize. It's something that requires more analytical thinking. But you will stay on, I can guarantee it's worth it. But you need to stay on with it and practice for a while. Okay? So this can be overcome with proper training and practice, and especially with guidance. Options is tough to learn on your own. Okay? Because you will take a long time and you can get confused. And okay, this is one very important I would like to warn. Any leverage instrument can have an over temptation to buy too many. Just because it's cheap, then you buy 100 contracts of options, you can also die, okay? Yeah. So you need to follow money management. Yeah. So always have a solid money management. Each strategy that we teach have a clear money management. It has a clear process map. I call it process map. Each strategy a one-step, one-page summary, and the strict money management that accompanies to make options simple, okay? So this is very important for you to take note. And every strategy has its own psychological temptation. All right, so how do you get started if you are new or you are already trading, you have already traded for a while? Most important is if you want to be consistent in trading, not just pure ad hoc success, you need to have a framework, right? So I have a STPM framework, which is you have to have a way to select the right stock, whether you're investor, trend trader, swing trader, or intraday. How do you select stock first? You need to have the clear strategy. The next one is, can I have the next one? Yeah. After you select the right stock, how do you time? Where's your entry, where's your exit from the stock chart? Or if you're an investor, what is the right valuation, right? Yeah, I always have valuation and stock chart together. Then after that is where the protection comes in. So protection, you either put a stop loss or you can use options. Okay, you can use stop loss or you can use options. So that's where options come in. And last but not least, we have this framework called multiply. How to make it faster? When you make it faster, you can trade often. You use, instead of long-term investment, you do more short-term strategy, or you use leverage instrument like options, right, to make it faster with the same capital. Okay, so it's called STPM process. It's a very systematic framework that we have. All right, so I have a very short time. I know options has a lot of questions, and you may have some questions, but I want to honor the next speaker time. So this is something that I'm doing for my own students in the current student. We have 7,000 students, right, across the APAC. I originally already have this, so I've talked to my team. Let's open up to people here who have questions, right? It's a Q&A. It's going to be, you can mark down this date, it's online virtual, right? 13 December, Saturday, 10 a.m. to 12:30, right? If you want to find out more about options or you have this concern, is it risky or whatever questions you have, join our sessions. Okay, is there a QR code? Let me see, okay. There's Yongxin, is there a QR code? Oh, okay. Oh, yeah. How many of you have this handout? Everyone has the handout? Okay, so the handout has a QR code. You can scan that and register for the session. And that's it. Okay. Can I, any more slides? That's the last one, right? Okay.
Thank you, Catherine.
So, yeah, thank you. So I hope, how many of you can understand what I'm talking about? Raise your hand. How many of you are inspired? You want to learn about options? Raise your hand. Okay, so if you're interested, do join us. But for those of you who has not really got a strong foundation in stocks yet, stock trading, or you have been trading for years but you don't have a systemized process. I come from the factory. If you don't have a SOP, you cannot repeat the success, right? We are the most systemized course that you can find in the market. Okay, so you can also join our weekly webinar. Go to our website, beyondinsights.net. Right on the top right, you can join our weekly webinar. You have a 3-hour webinar on a systemized framework on stock trading. right? The one I shared just now is more on options, right? But make sure you have a strong foundation in stock before you go for that. All right, thank you so much.
Yeah, thank you, Catherine. Can we have a warm round of applause again? Thank you.